All right, hello and welcome to this session. One of the many ways we are providing service to our clients is to present this wealth creation opportunity through life savings for the young ones. Now, before you think you know what I'm going to talk about, please give me a moment and just hear me out. Now, this is an amazing wealth creation vehicle that offers savings, investment, and legacy building, which keeps growing and even outlive you. We call it the making of the millionaire baby. Today, I'll be showing you how the rich and mighty are setting up their children and generations yet unborn for continuous flow of wealth. Also, the immense opportunity that comes with just setting aside any amount that is convenient for you, maybe even the amount you receive in child benefit as a wise parent planning for the future of these kids. Let's get right into it. Looking into the future, there are three major life events in North America that most parents want to be concerned about when it comes to setting up their children's future. The first is the post-secondary education. This isn't free. You will have to pay out of pocket, or your kids have to take a student loan and then try paying it off for a long time. Now, the second life event may be buying a house, buying a car, or getting married, depending on whichever comes first, right? Now, this event costs money, and only wise parents plan for them. The third is when they want to retire from a job or want to start a business of their own. The question then will be when and how do they make this dream possible? Would they even have enough money to accomplish this goal? These and many other concerns have left some families hopeless. Some have looked at options that can't really deliver the needed solution to them. The question of how do I build a legacy for my children is what most parents want an answer to. Every month, the Canadian government supports families of low and medium income earners with money that is known as the child benefit, with the idea of helping with bills and expenses that comes from raising kids. What parents do with this money is a different kettle of fish altogether. Some spend this free money, but some put it into investment to be able to address future concerns. The rationale, I believe, should be that you take care of your own children without any assistance from the government, and then invest whatever you get as child benefit. Don't you agree with me? In the bid to help some families, now the government has come up with the RESP, Retired Education, or sorry, Registered Education Savings Plan. Now, this is a good plan to the degree that it can help in certain ways. It, however, has many limitations and setbacks, which makes it not a so good vehicle in addressing the total concern of parents regarding the future of their kids. Now, here are some facts about the RESP. One, if you put money in this special account, now the government will give you 20% on that money to a maximum of $500 a year. Now, meaning if you put 2,500 in an account for a year, the government will add $500, meaning you have $3,000 in that account. Now, if you put 1,500, now they will add $300. Now, if you put $4,000 in that account, they can only add $500 because that is the maximum they can add to it. Now, the money in there grows as per the interest offered by the bank where that RESP account is set up. Now, part of what we offer our clients is that the institution where you put that money will help you channel that to get maximum interest possible. Now, the truth that you don't know is this: whatever bank you keep that money with, they also will take your money and invest it at a higher, much higher interest rate than what they can ever offer you. But we have access to those investment companies directly so that you can get the best interest rate that your money truly deserves. And number two, the growth of that money is tax deferred, meaning till withdrawal is to be made. So the moment you want to withdraw, That money is fully taxed now. Number three, there is flexibility of contribution to a maximum of 50,000, in that account. And number four, you can also have multiple beneficiaries named for one RESP. Now, what you have noticed is RESP can only, and I repeat, can only be used for educational purposes. The moment the child or beneficiary chooses not to go to school, uh, the funds that the government have added will be withdrawn. And the interest that you have accrued over the years on that money is now fully taxed. As a matter of fact, there are penalties already in place if you decide to take the funds out for non-educational purposes. Now, types of RESP. We have the individual RESP where one child is named as the beneficiary. You have family RESP where multiple children in one family can be named as the beneficiary. So if one does not use it up, the other one can take it up, and so on and so forth. And we also have group RESP where some group come together, pull funds together for the benefit of education for the kids that are involved in that group. Now, different from RESP, and looking at overcoming all the limitations of the RESP, we introduce our clients to the wealth plan for kids. Why do we do this? For some, the game plan is to leave wealth for the coming generations, to empower them to do the things that they have been called to do without having to worry about or be limited by money. Wow. Now, if this sounds like what you want, we can help you set that up. Or whatever it is that you desire for your children and the generations to come. This wealth plan is a combination of many elements. Number one, it's an investment that grows throughout the life of that child at the best interest rates ever. Number two, it's savings for you. Yes, you put any amount aside for a selected period of time, maybe 10 or 20 years, depending on what you want. And number three, there is access to cash at different life events, maybe for university education, buying a car, buying a house, planning a wedding, and the investment keeps growing even after you have accessed these funds. Number four, this is signing up for a permanent life insurance for the kid at a cost, I repeat, at a cost locked down at a child's age. This also has critical illness coverage added to this. Now, I hope you know that generally speaking, life insurance, the older you get, the more expensive the premium you pay. But this very one, it locks it down at the age of that child when you apply for this. Now, even better is the fact that you, the parent, own and control this policy. Yes, you're the owner, you control it, and you can transfer it to the child whenever you see necessary. Maybe the child is now old enough. You can decide to transfer this policy to the child. And your savings will help them not to struggle in life. You said give them a head start in life. And I'm telling you, it's beautiful that it empowers your children for lasting financial success and security. Now, this work plan is achieved by using the whole life insurance vehicle. Now, that's the vehicle we use to achieve this millionaire baby dream. Now, what is a whole life insurance? Now, just as explained previously, it's an insurance policy meaning that there is death benefit payout in case of the death of the insured. That is the child that is insured. If anything happens, God forbid, there is a death benefit payout to the parent. Now, it gives you payment of constant premium, over a great period of time. If you, like I said, 10 years, 20 years, that is for how long you pay the policy premiums for. And after that, you don't pay anymore, but the coverage still remains and the investments continue to grow. And of course, like I said, there is cash value access at different life events of your child's life. Now, let us compare this wealth plan with the RESP options. If you look at the issue of savings, of course, yes, both are savings in it. You say that, yep, we'll give you that. Now it's using the child benefit government grants. Yeah, you can use that for this. You can use that for work plan also. Now, tax sheltering. Aha. Now, for the RESP, you pay taxes on it. But for the work plan, when the monies you take out, there are no tax implication on that money. And talking about flexibility of the usage, the RESP is not flexible. You can't take it out for non-educational purposes. But the work plan, yes, you can. At different life events, you can use that. Now, critical illness protection. The RESP has nothing to do with critical illness. Like I said to you, but on the work plan, you can have a critical illness component attached to it. Life insurance protection, of course, RESP has nothing to do with that. But this work plan gives your child a life insurance plan in place so that when they grow old as you are, they don't need to go looking for a life insurance policy themselves. What you've gotten them 20 years ago can come into it is what they have. They don't need to get an extra one, except they also want to set something up for their children too in the future. Then talking about multiple life, then like I said, you have access to cash. RESP cannot do that. It's strictly for educational purposes. But of course, the work plan gives you access to that multiple life event. Then generational wealth transfer. This is one beautiful thing. Of course, the RESP, you can transfer that to your grandchildren, but the work plan, you can transfer the policy on your children to the grandchildren as the beneficiaries. So there's a lot you can do with this work plan. And that's why I said the rich and mighty are using this to set up their kids for life. All right. Now, I ask you again, what do you want for your own family? Why not write your own legacy just the way you want it? Whatever it is you desire for your family, that we can help you achieve financially, of course. All right, it's up to you. What do you want? Now, we'll give you an example here, a few examples just to show you case in point. Now, here is a child of 15 days old. Let's call him Ola. Now, Ola's mom wants to set aside $300 a month for 20 years. All right. She wants to invest $300 every month for the next 20 years for Ola. Now, when we are doing this and showing families and parents how we can invest, set up investment for their children, we usually go through either two routes. The first here is what you call the premium to coverage. Now, this is using a predetermined amount to see how much coverage we can get the child. And the second one is coverage to premium, which is using a desired coverage amount. How much do you want to be covered for? All right. And we use that amount to determine what the premium will cost. Okay. Now, in this case, Ola's mom has chosen to set aside $300 every month. So she's using the premium that she wants to pay to determine the coverage that Ola will get. So let's see the overall picture of what Ola is getting if Ola's mom sets aside $300 every month for 20 years. Now, the next slide here is what we have. This is Ola. The mom is a male. The mom is paying $300 every month for 20 years. Now, after 20 years, she would have paid $72,000. You agree with me? Because if you multiply 300 by 12 by 20, you'll get 720. So after 20 years, she has paid $72,000. Now, because it's premium to coverage option that she chose, that $300 option is getting Ola a life insurance coverage. Remember, it's permanent, meaning that Ola is covered till Ola is 100 years old. Okay? Now I'll explain some things to you as we go on. But this $300 every month is getting Ola $275,000 coverage with 50,000 critical illness coverage. Now, you know that statistics in Canada is gradually coming to 1 out of 2 Canadians before the age of 50 will be diagnosed with a critical illness. Talk about cancer, heart failure, kidney failure, stroke, and name it. So this policy already is getting Ola a critical illness of 50,000 now till he is 85 years old. Now, what are the life events and what does this money come to? Remember that Ola's mom is paying for just 20 years. At the time, and Ola is 15 years old, so age is actually 0 at that point. Now, at the time that Ola is 25. That is 5 years after the mom has stopped paying premium. She stopped paying, but Ola is still covered. The investment is going and accumulating and growing. At age 25, Ola wants to go to university. Okay. How much do they have access to as cash value? They have access to potentially 114,000 with change. Okay. Now, remember, all that Ola's mom has paid is this $72,000 combined for the 20 years. But they have access to this money. Isn't that savings and investment, or what do you call it? Now, this is just the lower end of the possibility. It could be way more higher than that, depending on how the market does, which we put it into the best interest rate, like I said. And now, the life insurance that they got at the beginning for 277,000 has now gotten up to over $800,000, and Ola is just 25 years old. Can you imagine how much you will pay to get a life insurance policy of 800,000 at 25 years old? If you do the math and you ask an insurance person, ask me, I'll tell you, it's ridiculously high. It's definitely not going to cost $200 for 20 years. No way. All right. So this is it. But remember, the critical illness is still there because it's supposed to go till Ola is 85 years. Remember that? All right. So now, why am I telling you this? Now, 10 years after, this is now 15 years after Ola's mom has stopped paying premium. Ola is now 35 years. Say Ola wants to, I don't know, buy a house or buy another car. The potential cash value has gotten up to over $220,000. The life insurance death benefit that was 277 is now a whooping 1.1 million just in 35 years. Isn't that phenomenal? And the critical illness is still there. So by the time Ola is retiring at 65, the potential cash value is at 1.3 plus. It's bigger than that. I'm just using this value here. And on and on and on. By the time Ola is 85, it has risen to over 3.6 million. The death benefit over 4.7 million. And the critical illness is still there. All right. So the point is this. This is how much that was contributed. Savings of 72,000. And look at the possibilities here, people. All right, so that's what I said. Let me show you another example here. Ola is a female, okay, and the parent decides to put just $120 aside for 20 years. $120. What is that getting, Ola? Now, if you do 120 by 12 months in a year, by 20 years, it comes to $28,800 total. That's how much they're going to pay for the total of the 20 years. But that policy has gotten Ola an $86,000 life coverage, of course, with critical illness of 50,000. Now, these values can be changed depending on what you want. You say, okay, Ola, help me with this. I want to pay, I can afford to put aside $200 every month for my child. I can afford to put aside $100 for my child. I can afford to put aside $250 for my child, $300, $500. Some people even do $1,000 for the kid every month, depending on how much money you make and have. We can calculate how much premium that will come to and show you the progression of growth, what it will come to in the next 10 years, what it will come to in the next 20 years, what it will come to in the next 50, 60 years. The critical illness is up to you. You can choose 30 years, you can 30,000, sorry, you can choose 70,000, depending on what you want for your kids. It's up to you. All right. So whatever you choose, using the premium, we'll calculate the coverage. Or if you say, look, I want a coverage of $500,000. How much would the premium cost? We can go that route too. Remember, I told you we can go two routes, premium to coverage or coverage to premium. So we can find this out for you. Imagine this. Ola's mom here, just putting aside 120 every month for 20 years, have contributed to $28,800 in the 20-year period. But look at the cash surrender value. After that 20-year period, the moment they stop paying, they have possibility of collecting this amount of money. All right. Because it's little, then the growth is not that fast. All right, but at 45, this is how much money they have access to. At 60, this is how much money they have access to. At 85, this is how much money they have access to. And if anything happens to Ola, even after paying for 20 years, like I said, what they bought for $86,000 has now gone up to $198,000. At 45, it has gone up to 477. Wow. And at 60, look at how the amount keeps growing. At 85, that money is 2 point something million. And you, as a parent, if you don't transfer to the child, you can write in your will and testament that, okay, I name Ola's children as beneficiaries so that when Ola passes away, Ola's children already have the inheritances from you, from Ola, and their life is so much good. I used to wonder, why do non-Africans, okay, why do they take flowers, roses to their grandparents' grave every year, every month, and they say good things, they're crying? It's because there's been inheritance left for them. I'm sure if you get a mail today that your grandparents left you $50,000, $100,000, won't you take roses to their grave every year? Of course you will. So I'm saying these are the ways that the rich have put things in place to safeguard the future of their children. And the example keeps going on and on. If you do 250 every month for 20 years, you would have paid $60,000, and that coverage at that time will get you 177,000 plus coverage with critical illness of 50,000, depending on what you want. And look at how much money you have access to, how it's growing at different period of the child's life. So this is what I said to share with you and to show you the options that are available and what you can do. It's savings, it's investment, it's you writing your own legacy for your family and choosing exactly what you want for them. So the ball is in your court. So please get to me. Let's sit down. Whatever it is you can afford, let's come up with something for you. And I'm sure that your children, your family will be glad that you did. Thank you for taking the time to watch this. And please do get back to me. Thank you.